Hello and welcome to another edition of Symmetry Spotlight, where I break down financial topics and common investment questions with the goal of helping you make sense of the world of finance. We're all human and the markets can be very noisy at times. This combination is a recipe for emotionally driven decisions. In my career, I've seen plenty of instances where investors get themselves into trouble by letting their emotions drive their investment decision making. A lot of times, fear pushes us to sell when prices fall, which locks in losses. Greed tempts us to chase hot investments, usually buying high and hoping for more. Both instincts served our ancestors really well in survival situations, but investing, that usually works against us in the long term. So today, I'm going to be breaking down 3 common emotional traps that investors fall into and how to avoid them. The markets move every day, sometimes with pretty big swings. When you see a big drop, your brain treats it like danger. The urge is to do something, sell, move to cash, hunker down. But research shows time in the market beats timing the market. Short-term reactions can turn temporary drops into permanent losses. A calmer approach is to focus on your financial plan, not the daily headlines. If your goals and your risk tolerance haven't changed, then neither should your portfolio. Also, we can anchor to history as a guide. The markets have seen many different crises over its tenure, which is reflected by this chart from First Trust. Since 1970, there have been dozens and dozens of events that at the time, this was a crisis in our brains. And yes, the markets probably experienced some volatility during these events. Past performance doesn't guarantee future results, but every crisis eventually ended, and the market eventually rebounded and kept growing to reach new highs, rewarding the investors who were patient. Recency bias is the tendency to overemphasize current events based on past experiences. If stocks have soared, we expect them to keep going. If they've plunged, we expect continued decline. If you are an investor who experienced the 2008-2009 financial crisis, that was a tough time in history. But not every current drop in the market means that we're heading for another financial crisis or a big stock market crash. Herd behavior compounds this. Herd behavior is the tendency to kind of align one's decisions with that of the larger group. Buying because everybody else is buying, or selling because everybody else is panicking and selling. The result usually ends up in buying high and selling low. The antidote to this is disciplined, rules-based investing. Diversified portfolios, periodic rebalancing, and making clear decisions that are tied to personal financial goals rather than the market headlines. Loss aversion means that losses hurt more than the gains feel good. That can cause people to hold on to losing investments for too long, hoping to get back to even, or to overallocate to supposedly safe investments that aren't going to meet your long-term goals. Both of these can impact your overall portfolio return, which can have a negative impact on your financial goals. Mental accounting is when we treat money differently depending on its source or its label. For example, maybe you are very strict about saving your normal income, but bonuses get spent on needless big purchases. Or keeping cash in low interest savings accounts while holding on to high interest debt. Good financial decisions treat the whole plan holistically, considering risk, return, and time horizon across your entire portfolio. So, how do you keep your emotions in check? Here's 4 practical steps. For starters, have a written plan with defined goals, timelines, and target portfolio asset allocation. A written plan makes it easier to evaluate your decisions objectively and cross-check the trade-offs between making these decisions. Another thing you can do is try to automate your financial decisions. So set up regular retirement account contributions, automatic bill pays, automatic account rebalancing. If the decision is made for you, then no decision is needed at all, which reduces the risk of possibly making the wrong decision. Another thing you can do is focus on what you control. You can't control the markets, but you can control your reaction to it. Remember, the scariest crisis is the one you're currently in, mostly because you just don't know the ending to it. The ending will eventually come. Lastly, take a pause before making big moves or making big financial decisions. When you feel a strong emotional urge to buy or sell within your portfolio, or make a big purchase of something you think you need, sleep on it for 24 or 48 hours, or get a second opinion, see if you still feel that same way. And to be clear, emotions are not inherently bad. They're signals. Anxiety might tell you your asset allocation is too aggressive for your comfort. Excitement might be a signal that you've identified a genuine opportunity. The key is to try to translate those feelings into data. If your emotional response reveals a mismatch within your plan, then adjust your plan deliberately, not in a mode of panic. And one last point, if you're watching this and you're not currently a client of ours, then know that working with an experienced advisor can help reduce emotional mistakes. An advisor provides perspective, discipline, and we can help kind of reconnect your decisions to your long-term goals. If you've ever felt overwhelmed by market moves or unsure of whether your asset allocation still fits your goals, it's a great reason to schedule a meeting with a financial advisor. Thank you for watching. Hopefully you found the information useful. But if you have any additional questions, don't hesitate to reach out. Otherwise, I look forward to talking with you again soon.